Hi there, you're watching the daily edition of Your Trades. I am Priyanka Uppal, along with me, Snehi. Snehi, today is a perfect case study when you say it's a combination of the weak macro cues and the downgraded economic growth forecast for the domestic. What actually weighted on the markets also? Dollar index inching higher. It's about 109.87 right now. US bond yield at 4.79%, which has jumped to the highest level since November 23rd. Rupee crossing 86 against dollar. And of course, the kind of news we've seen in terms of crude US sanctions on Russian oil that could disrupt the Indian oil exporters and the ballooning of CD. And along with that, the kind of the rupee move, sluggish economic growth. We do have CPI data also on the tab today, but this all resulted in a market cap erosion of over 13 lakh crore on BSE listed company. A day where all sectoral indices have closed in red. All the 50 constituents on Nifty have closed in red. Not a single sectoral gainer today, what we saw. Nifty closed below 23,100. Around about 300 points it slipped from its high point. Bank Nifty slipped around 800 points, closed around 48,000 at this moment. All that combination, and we've seen Nifty reality that got the most hit, hammered by 6.5%. Metals lost more than 4.5%. PSC index lost more than 4%. Small cap, mid cap, they've been trading at the 6 months low. A day to actually remember, Snehi. All that key data points on the flip side, on the negative side that we saw today.
Lots of macroeconomic pressure coming in, and of course a lot of sectors, in fact all sectors have closed in the red. A couple of 4 stocks from the Nifty 50 have managed to close in the green. All of them have respective news flows, either earnings reactions coming in, you have brokerage notes, or you have HUL for that matter that has demerged the ice cream business into quality walls now. So everywhere we have some visibility of earnings, like Priyanka says, some visibility of earnings or some news flow coming in, some brokerage report coming in. There we've seen momentum in the green. Otherwise, the entire market has ended in the red today. Broader markets taking the biggest hit on the chin today. India VIX is up 7%, a big spike on an intraday index coming in, which means that this is a market where we are seeing very low returns and high volatility. So we have reversed from the periods where we had the bulls taking charge of the market. Volatility used to be low, returns used to be great. And that is completely reversed right now, because 16 is where we have reached on the India VIX today. A massive spike coming in today's trading session as well. So yes, this is what the advanced decline ratio is also looking like. Out of so many stocks, you only have 226 in the green and more than 2,400 in the red today. That's what the market breadth is looking like. But on that note, let's also go across and listen into what has caused this Monday mayhem on D Street. You had Nifty plunging below the 23,100 levels. So that is something that is not doing well for us. It's a 7-month low coming in. Global cues continue to ail Indian markets as rupee 2 tumbled to a record low against dollar, with crude surging post the new US sanctions on Russian oil. What lies ahead for the Indian financial markets? Let's go across and listen to comments and insights by Nikunj Dalmia on the same.
It is nothing short of a perfect storm, and a lot of things actually have aligned against us. If one really looks at the global setup, it is a combination of dollar index, rising yields, and the fact that flows are moving out of not India but emerging markets, including China. So what was supposed to be a consensus trade that money will come back to emerging markets come 2025, that has not translated into reality, which in a sense is having an impact at the global level. So that's the global setup for you, where just about every emerging market has started correcting. Some of the popular markets like India, that's where the gains are the highest in the last couple of years. So I guess they are the ones who have fallen the fastest. Now, how long will this interplay where everybody is hiding into the dollar, or this excitement ahead of Donald Trump inauguration, how long will this last? That's anyone's guess. But my sense is that this is becoming more like a crowded trade, and crowded trade, they seldom last beyond a point. So I'm not saying we are at a point of climax in the global market, but the risk reward ratio now to perhaps buy anything which is largely dollar denominated at these levels clearly cannot be made. So on global level, while the screen is not looking all that exciting, you need to start thinking that how long will this weak dollar interplay will continue. Second is rupee. Completely contrary to what everybody was anticipating and expecting. Rates were supposed to come down globally. rates were supposed to come down in India. India's core fundamental, which, for rupee to deteriorate, it's a combination of macro and micro. The micro has been slowing down and the macro has been stable considering where the fiscal deficit is, where the high frequency data point is. But the fact that flows are gravitating out of India, Reserve Bank of India's forex reserve has used the forex reserve, that is not helping the currency either. But the problem for the market is not global or currency. I think it is a breadth of the market where mid and small cap stocks are really on the butcher block. And that's where I guess the problem has come in. We must bear in mind that while we may look at today's fall in isolation, or we can add back last week's volatility and say that, okay, this looks like a very, it is a scary number to look at when you look at the magnitude of the fall. But this is something which I think markets have periodically told us. The same PSU stocks which had no sellers are finding no takers. On an average, the decline in PSU stock is more than 35% for these stocks which have appreciated or which had appreciated by 3 to 4 times. So excesses in the market, I think, they're getting out. The HNI and the ultra HNI community, which in a sense was in a mood to only buy and buy and buy and never sell, suddenly is selling without thinking. So there is, I won't use the word panic, but there is definitely a lack of participation which is making the markets look hollow, and markets today are falling on low volumes. Now, where do we go from here? I think that is the most important thing. And I think there is no easy answer. I can stick my neck out and say that last 3 years, we've had a setup of low volatility and high returns. I think we're entering into a setup of high volatility and low returns. To make a case that, okay, we are nearing any kind of a bottom, it would be very early. However, to make a case that, the bull market is all over, I think that's foolish. What you need to do in this market is that ask yourself that why you own that stock and what is your time frame. If you keep your return expectations low, extend your time frame, and if you know what you bought, I think you'll survive this. But if you own something which is in leverage, if you don't know why have you bought it, and if expectations are that, oh, you bought the stock and you'll make 50% return in next 6 months, I think that's a silly and foolish kind of return expectations. So what will save you in this market is your identification of the stock, your ability to hold it for next couple of quarters or maybe couple of years, and then keep your return expectations low and understand the business which you own. If you put these filters, I think this would be a passing correction. It's not for the first time in this bull market also we've seen this correction. 2022 we saw this kind of a correction. Before Ukraine and Russia crisis, after the crisis we saw this kind of a correction. We've seen this correction, I think, same time in March or April also, where the mid and small cap stocks, they came and they really got chopped. So it's not that it is game over for the bulls, but yeah, there is definitely a lack of momentum. There is lack of participation. There is no real compulsion for anyone to buy, and that is the ugly part of the market. When the going is good, you get blinded because of the momentum, and when the going gets bad, I think you get blinded by what the opportunity is. So that's my limited point here, that if you don't know what you own, I think it's a bad time to own those stocks. Increase your risk horizon, and then keep your return expectations low.
All right, so clearly what Nikunj pointed out, looks like we need to embrace the high volatility, low return scenario this year, which could be on the cards, understanding the global setup as well as the the high frequency economic data which is indicating. Moving on, we are, of course, the kind of movement we saw on rupee, which has hit the all-time low versus US dollar. It's at 86.5. Now, we did speak to Jayesh Mehta, who is from DSP Finance, to decode the factors driving the decline in rupee and understand when we can expect the currency slide to come to a halt. Listen in what he exactly said.
FPI selling is also dollar outflow, right? So we don't have that much of depth in the market. If we have daily outflow of $300 to $500 million for FPI withdrawing that money, that will be, of course, in a global dollar strengthening market. You will also have traders coming in to take along with that side. So all that put together at this juncture, it's not only us, other currencies are also impacted, but we are impacted more because we kind of remain very tight when the initial outflow happened in August, September, October. The consensus trade is to basically every other market bad, it's only US market. I think at some point of time it will change, and that's when we might start seeing, at least if not new inflows, but at least the exits once they start stop. That's where the currency will stabilize.
Okay, that's the word coming in from Jayesh Mehta on where he sees the rupee heading? But on that note, let's also welcome on board Richard Jain, the Vice President, Equity Technical Research, Wealth Management at Motilal Oswal Financial Services. Richard, hi, thanks so much for joining us. One simple straight question to you. First up, 23,000, we've barely held on to that level today. Tomorrow, do we slip below that?
Yeah, hi, very good afternoon. Well, the way the global cues are panned out and many other data is panned out, it seems that we would slip below the 23,000 mark. So primarily what I am talking about is, definitely one of the data that is US, bond yield rising, which is not good for the equity markets. And also the recent, breakout in the dollar index above 108, which has led to sharp depreciation in our currency. Now, add to it that FIs outflows. If you look at the long short ratio of FIs, around 85% of the positions in the index futures are on the short side. And on the other side, if you look at positions of client section, that is retail traders combined with HNIs, then about 70-71% positions are on the long side. So although the positions of FIs is short heavy, but they are still sitting comfortably in profits because they have been creating shorts in the start of the series itself. But that 71% long ratio by client section, the HNIs and the retail section. So I think that's where the losses are there, and they may look to cover these positions or unwind those positions if the market continues to underperform. So I think that would be the thing that this which would lead to further market correction from current levels. And major support for the market technically is placed around 22,800 to 22,850 range. So I think we could slip below the 23,000 mark. So ideally around 22,800, 22,850. No, this is the range where we would look out for any counter trades if we get any signs over there.
So, Richard, you're saying that we could slip further, and the next level to watch out would be 22,800, 22,900, which is nearly 150 odd points from here. Now, since up till now we've seen till last week we were seeing that the major cuts, deeper cuts were coming in broader market, but today the kind of sell-off we've seen in large caps also, and especially the stocks which could barely close in green were ahead of the numbers, or maybe some trigger there. Otherwise, it was broad-based selling. All sectoral indices participated in it. The kind of reality, metal, PSE space, they saw the maximum of the hammering and the maximum of the damage coming in. Do you think these sectors will be prone to more damage from here, or there could be banks which also could be on the radar, because bond yield, the way you said, is also inching higher?
So, Priyanka, yes, definitely. When you go into some advanced stage of a corrective phase, then there are seldom any stocks or sectors which would stand out. So that's why we have seen that as the correction is getting extended, all the other sectors which were holding out so far, I think we could clearly see an unwinding pressure there too. IT was one of the relative outperforming sector, but today even except one or two stocks from the IT heavyweights, we witnessed a good sell-off there too. So as of now, there is no signs of bottoming in the broader market. So yes, especially the rate-sensitive sectors such as realty is there. PSU banks are there, which the rising US bond yield is negative for them too. So I think such rate sensitive sectors would continue to see some further sharp correction.
Let's say you're not seeing any bottoming out right now, but amid a market like this, what should an investor's strategy be? Is there comparative some amount of safety in large caps when you compare them to your broader markets? Because if you see the kind of decline small cap has seen, it's roughly lower by around 10% in the last 2-3 sessions itself. In fact, rather more. It's the broader markets that have been the biggest contributors of this decline. Do you think there is some amount of safety, or would you call the large caps a safety net in a market like this, or do you believe the best strategy right now would just be to wait and watch?
So I think that depends on more on time horizon. So if you're a very short-term trader, then definitely such kind of markets, even large cap stocks does not provide that safety. But yes, the relative correction in the large cap would be lesser than what you would see in the mid cap and the small cap space, because mid cap and small caps have always been high beta. When you see high trended up moves, these these spaces give to show a good outperformance over the benchmark of the large caps. But similarly on the opposite side, when the markets correct sharply, then mid caps and small caps underperform, which we can clearly see in last 1.5 week. So I think yes, if you are looking from a very short term perspective, I don't think there is much place to hide for now. But yes, in large cap, relatively you would see lesser correction compared to the mid caps and the small caps.
Very quick question, Rajat. Would you want to take a trade tomorrow morning after 9:15? Or are you sure that you are going to sell on the rise?
So Priyanka, I'll have a combination of no buy and sell. No, as you said, no, this is the market where things are quite tricky if you look at from a near-term perspective. Emphasis is one stock which I would recommend going short tomorrow in the morning itself. So primarily after a long period of time, the stock has given a close below its 200-day exponential moving average. The previous singular support has been breached. So I think this is one stock. In fact, I know some of the IT names have started unwinding of positions in today's trading session after a no good phase of consolidation post TCS results. We witnessed some positive activity, but there is no follow up except in couple of names today. So emphasis, I think, would see some price wise correction over here. One can go short with stop loss about 2850 in the future segment, expecting target somewhere around 2650. And relative safer plays, I would say HUL would be one stock where downside seems to be very limited from here on. So in case if one is looking for some buying opportunities, or as we said, no some place to hide where correction would be lesser than the markets, then HUL I think one space where which looks good over here. So one can go long with stop below 2380 for potential targets of 2550.
Ruchit, so emphasis on the short side and HUL on the upside. Those are Ruchit's picks coming in. Ruchit, thank you so much for joining us, giving us such a detailed outlook on what we can expect tomorrow, and also sharing your picks with us. But on that note, we'll slip into a very short break on this edition of Your Trades and keep it going with more about the day that we've seen today on Dalal Street, right on the other side of the short break. Hi there, welcome back to Your Trades. Let's take a look at some action coming in from the world of derivatives today, how the FNO space was shaping up. Now, the index future trends for this January expiry for Nifty, we're seeing some short build up, and ditto for Nifty Bank as well, short build up on that front as well. And that's not surprising to see at all today, because if you take a look at the India VIX, that's at 16. We've spiked more than 7% today just on an intraday basis. So that's what was happening with the volatility in the market. If you take a look at the active calls and puts, active calls for the 16 Jan expiry, which is this Thursday, call writing was seen at 23,200 and 23,300, making 23,300 the next resistance level or the next hurdle that the Nifty needs to cross in order to gain that upward momentum. On the put side, on the active put side for this Thursday's expiry, put buying seen at 23,100 and 23,000. We do not have a visible support level right now, because this market, like even Ruchit said, is expected to fall further. So we'll just have to sit tight and watch out for the next support that we're seeing in the market. But well, yes, 23,300 is the upside level that we need to cross, and the one that we're watching out for.
All right, so 23,000, it can slip below that also. Let's see, will there be any part of any respite coming in tomorrow, or the momentum continues? But in the meantime, there were plenty of stocks which are buzzing in trade today. Rabinder is standing by with the list of those stocks. Rabinder.
Well, Morgan Stanley has come out with a note on AB Capital, and they have upgraded the stock to overweight rating with target price of rupees 247, and the AB Capital stock has fallen 24% in last 3 months as compared to a 5% drop for Sensex. And Morgan Stanley expect AUM to grow at 20% and EPS at 18% CAGR over FY24 to 27, and they say that the company has maintained decent asset quality over the years. Moving to next, PB Fintech is also in focus on back of brokerage note where Morgan Stanley has downgraded the stock to underweight with target price of rupees 1400. They concerned about the FY27 EV to adjusted EBITDA being high at almost 65 times, and the profit growth has been weaker than expected. Morgan Stanley says that the strong stock performance has followed high growth in new business premium, but this growth is expected to slow down in FY26, and Paisabazaar is also facing some challenges. Moving to next, Ola Electric is also in focus, where company has received a further request for information from the Central Consumer Protection Authority, and this follows a previous show cause notice that the company has received from CCPA. And lastly, on back of Q3 result, PCBL is also in focus, where company's revenue has grown by 21.3% year-on-year basis, and net profit was down by 37.2% year-on-year basis at 93 crore, and the EBITDA margin was down by 100 basis point year-on-year basis.
Okay, Ravinder, thanks so much for joining us with a list of all the stocks that were in focus today. But with that, we completely timed out on this edition of Your Trades. Thanks so much for watching.